Hi there, this is Jim Kruzan, and welcome to this quarter's Capital Market Review. As I do every quarter, I come up with a word or a phrase that best typifies the last quarter's progress. And for this quarter, I've chosen volatility resumes. Now, I know a lot of you will agree. It seems like this last quarter we've had a tremendous amount of volatility. But the reality of it is that the volatility now is really no different than what it should be in a normal market. It just seems far greater considering where we've been. Last year was a very atypical year. In fact, you'd have to go back nearly a lifetime, well over 70 years, to find a year like last year. And what I mean by that is last year the S&P 500 was positive each and every month for the full 12 months. Looking at your statement in a volatile investment portfolio looked like watching a bank statement. Every period it went up, and that's typically not what happens. In fact, as I said, it's taken 70 years. So today we're going to focus on the economy, and we do this because we feel it matters. Things like jobs and profits and inflation really drive what will happen to the economy and the markets. We attempt to answer a couple of questions: where we're headed and where we are today. In our weekly meetings, in our investment meetings, we try to get two things right. We try to answer two questions. Where do we think we are in this economic cycle? And where do we think the Federal Reserve is? And what are they most apt to do next? You see, the economy goes through four phases. It always goes through four phases. We have a recession, followed by a recovery, followed by what we would call slow economic growth or a mature market, followed by an aging market or an economic slowdown. And depending on where we think we are, there's always a list of securities or sectors or investments that we want to give special attention to because they're better suited for that period of economic activity. And consequently, there are others we want to avoid or have less of. We do all of this so that you're better informed, so that you can stay balanced, stay diversified, and also stay invested. Our agenda today is really pretty tight. We're going to talk about all things economic. We're going to look at fundamentals and valuations. We're going to look at positioning. We're going to start by talking about growth, jobs, profits, and inflation. Then we'll take a look at things from a global picture. And then we'll also take a look at the Federal Reserve. And when it comes to valuations, we'll want to look at bonds and yields. And then we'll turn to stocks and look at PE ratios. And then we'll take a look at the international markets. And then finally, we'll take a look at the global class returns of assets across the board, and we'll see where we're positioned right now. So let's start by taking a look at the economy. You know, this is the 9th year of economic expansion. I often think of the economy much like a tortoise, slow moving, methodical, moving in the same direction. This year may very well be a tortoise getting a shot of adrenaline. It'll move faster. It'll cover more distance. But eventually that adrenaline wears off and we resume this slow, methodical plod. This year should be a good year for the economy on the backs of strong corporate tax reform. But at some point, things will start to slow up again. And I think one of the biggest reasons for that is the unemployment rate. This chart shows unemployment and the blue line shows wages. The unemployment rate right now is 4.1%. It is extremely low, especially considering where it was in the height of the financial crisis, over 10%. There's very little room for it to drop further, and that is the seed of the problem we might experience. In fact, if you go back the last 6 or 7 years, the U.S. economy has been growing at a pace of about 2.2%. But each year the unemployment rate has fallen by 0.6. And what that means is, if it wasn't for the fact that we were putting a lot of unemployed workers back to work, the economic growth rate might really be only about 1.6. And what we expect to see happen this next year is much stronger economic growth. And we may very well see the unemployment rate drop to 3.5%. But from there, it's very difficult to go much further. And as a result, if we don't have other unemployed people that can go back to work, then the wage force becomes compromised. And the simple formula is this: economic growth or expansion is a function of labor force times productivity. And if we don't have growth in the labor force, it's very difficult to have growth in the economy. So we expect economic growth to somewhat slow down. Before we go to the next slide, let's look at the blue line below. And you can see from a wage base perspective, wages have been increasing somewhat. Average wage increased about 2.5%. The line is moving in an upward direction, left to right. But clearly, in this environment, workers don't have a lot of bargaining power. All of that rests to a large degree still on the side of business. So we expect wages to continue to move up, but more slowly. And we certainly don't see a huge spike in wages over the next year. Let's now turn to corporate profits. And the profit picture for this year is excellent. What we've seen is really strong economic growth. We expect to see a falling dollar, which will also help international revenues. And higher oil prices have also helped out a lot of the energy companies. But the big thing this year has been the tax cut. Cutting the corporate rate from 35% down to 21% has been a significant boost to corporate business. And we expect corporate profits this year to increase something like 25% year over year compared to 2017. This is an extremely high level of profitability. And the bad news, if we can call it bad news, is that it establishes a very high bar upon which to compare from for next year. So we expect the corporate tax cut to not have nearly the same impact next year and beyond. So we expect corporate profit growth to be somewhat less robust and probably tracking something a bit closer to economic growth, 2 to 3%. Looking at inflation, the picture here looks a lot like the wage picture, surprisingly low. Again, we think that there are some structural forces behind this, the biggest of which is probably information technology. It's the ubiquitous use of this technology around the globe that has really empowered buyers, whether you're buying labor, goods, or services. And we think this information power has tended to push down inflation around the world. And we think it's still powerful today. As the economy and the labor force tightens, we think inflation will move up a bit, but not all that much. Looking at manufacturing, this is my favorite chart. It's the JP Morgan heat map. In this chart, green is good and red is bad. And if we look at this chart up to down, we have developed countries on the top and emerging markets down below. And if we go back to 2008 and the height of the financial crisis, you'll see everything was bad. And then coming out of that, you'll see Europe again closer to the top. They were still dealing with a debt crisis. And in the bottom, you'll see how a lot of the emerging markets also slowed down a bit. But that was because of the commodity bust. But today, everything seems to be growing. But more importantly, nothing is booming. And in there lies a certain certainty of stability around the world and in the financial markets. So let's take a look at the Federal Reserve. The Fed met recently, and they decided to raise interest rates in March. So the question now is, hey, how many more times this year do we see a rate hike? I think it's probably closer to 3. And we'll have to see what the data looks like as the year goes on. The level of interest rates right now are still very low, considering that this expansion is as long as it is. But I think that Jay Powell and the Federal Reserve will want to try to normalize rates. Read that as increase rates. So they'll have some tools available to better prepare to fight the next recession, whenever that occurs. So we expect further rate hikes this year, perhaps pushing the federal funds rate up maybe a full percentage point by December of this year compared to December last year. And we think the economy will grow a little bit more this year, but we also think we'll see somewhat higher wages, somewhat higher inflation, and somewhat higher interest rates. So what does this all mean to investing, in particular with fixed income? If we look at fixed income, and in particular this chart, which shows the 10-year Treasury over about a 60-year period of time. And it shows this both in nominal as well as real yield terms. If we look at this, we'll see that interest rates still are very low. In fact, going back over the last 60 years, the average real yield on a 10-year treasury, when we take out inflation, has been about 2.4%. Today, it's running something like 1%. So we certainly think that real yields will continue to back up and start moving higher. Today, that 10-year yield is running a little bit below 3%. And we think by the end of the year, it probably will be closer to 3.25 or 3.5. We think that short-term rates more than likely will rise more or more quickly than long-term rates. But long-term rates will rise. And that results in making it more challenging for fixed income investors. Overall, we believe a slight underweight in fixed income is better relative to a normal portfolio. Here at Kaydan Wealth, in our discretionary portfolios, we are running a slight overweight to short duration or low maturity and an overweight to credit, corporates, high yield, floating rate, as opposed to U.S. Treasuries, in the hopes of being able to insulate somewhat or reduce somewhat the impact of a rising interest rate environment. Since we talked about bonds, let's now talk about stocks, and in particular the U.S. market. This chart shows the PE or price earnings ratio of the S&P over the last 25 years. And what's interesting on this chart is what happened at the very end of the chart. On the far right-hand side, you'll see this huge drop in PE. Now that wasn't because of some big market correction. What it was simply analysts increasing dramatically their earnings expectations for earnings this year because of the corporate tax cut. And what it did is it pushed the PE from a level that was almost a full standard deviation higher than norm, what would be deemed kind of a uncomfortably high PE, to something now that is much more in line with the long-term 25-year average. So the market today is much cheaper, not because of a big sell-off, but because of improved corporate earnings. And we think that's very impactful. The thing to remember, though, is the market doesn't work just on PE. It also works on profit growth rates. And there we think we'll see somewhat of a slowdown because of the runoff of what corporate tax rates will do to earnings this year and the expectation that they won't do quite as much for next year. Turning to the international markets, I think there's a huge opportunity here. And again, at Kaydan Wealth, we're looking to exploit this by increasing our exposure to the international markets. This chart shows both the S&P 500 as well as the Morgan Stanley Capital Incorporated All-Country World Index ex-US. Boy, that's a mouthful. But what it really means is all stocks outside the United States. And this goes back 20 years. And what's interesting is in both cases, these have been somewhat sideways markets. In fact, in the U.S., we've had a sideways market from the mid-1990s until about 2011 when things really started to take off. And I know some folks, because we see them, hear them all the time, folks that are new to our practice may have said, but maybe I've missed the boat here. And the truth is, to some extent, if they weren't invested during that period of time, they may very well have missed the boat. But the good news is there may very well be another boat at the harbor gathering steam right now. And if you look at the purple line, it's been going sideways for 20 years. And it hasn't broken northward. It's the international stocks. And if you look at it in terms of valuation, their PEs are lower than the U.S. They generally pay higher dividend yields than the U.S. And if we think over time that the dollar could fall, that could further amplify the returns in the international investments. And frankly, in a lot of these countries, the expansions are younger and they have more room to run than in the U.S. So we think it's a great time to look overseas for some of the equity exposure. Before I move on to the next slide, let's take another look at this. And here's something I find really interesting. If you look back in the fall of 2007 at the prior peak, you'll see essentially both the US market and the international markets peaked in and around the same time. I will tell you for a fact that both bottomed out on exactly the same day, March 9th, 2009. And since then, the US market has been just up like a bullet, up 290%. Yet the international markets are up about 123. Moreover, the US market has gone up significantly, covering all of the loss from the prior high, which was October of 2007. And the most interesting thing is, to date, the international markets are yet back to those levels in October of 2007. So this may very well be a huge regression, a mean reversion. Those that have underperformed start to outperform, and those that have outperformed start to underperform. Pulling it all together, let's take a look at this chart, the asset class return chart. And this goes back over 15 years. And frankly, it's been a pretty good 15 years. What's interesting is that in spite of all the shocks, all the surprises, all the worries, and all the crises we've had over the last 15 years, the return on a diversified portfolio has been fairly healthy. The biggest anomaly in this chart is still the yield on cash. Central banks have been holding interest rates very low. They're beginning to move up, but they're still very low by historical standards. In the last 50 years, before the financial crisis, the real Fed funds rate, when you take out inflation, was about 2% positive. In other words, you actually got paid just for saving. Today, the real Fed funds rate is actually negative. You pay the bank in real terms for savings. In fact, what it really means is that because short-term interest rates are so low, you can't make money in the long term just by saving. You have to make money through investing. And when we look at the state of the global economy, we look at valuations, we look at the U.S. economy, we still think there's plenty of opportunity in long-term assets. And in real terms, when cash pays you nothing, it's still time to invest in something. Hey, if there's any questions at all, if you'd like us to expound on anything we mentioned, please reach out to us, give us a call, and we promise we'll respond promptly to your questions, and we'll act quickly on whatever requests you might have. And while we're still wrapping it up, I would like to offer you the opportunity to offer to colleagues, friends, acquaintances, an opportunity to have them sit down with us for a second opinion, a retirement readiness checkup. We have a very elegant process that we use. We call it our evolutionary wealth process. And it's a way of moving a potential client through our discovery interview, presenting options and opportunities, and then talking about how we would stay focused on their goals and objectives over time. So with that, before finishing this thing up, I want to make sure everybody has a chance to take a look at our disclosures. If anybody is interested in copies of this, by all means reach out to us and we'll be more than glad to give that to you as well. So with that, thank you. Till next time, I wish each and every one of you a very happy, healthy, and prosperous future. Until next time, this is Jim Kruzan signing off. Take care, and let us know if we can help in any way. Thank you very much.